touched upon quite a few things related to cross-border M&A activity today. And one thing that occurred to me is that a lot of the thinking, a lot of the approaches in and around these sort of things, in fact the core ideas around going into investments will depend on your business models and your comfort zone. Now you've obviously been present in the zone for decades, but can you elaborate a little bit about your thinking and some of the cases that you worked on vis-a-vis the sort of native cases and the regional expansion stories and so on?
Mm-hmm. I mean, we've made about 20 investments over the last 20 years actually in the region, so one a year roughly. Some of them in the initial years on the small side, and over the last couple of years larger, notably last year a almost 2 billion euro investment in Ahlsell, which is the region's largest technical wholesaler. Maybe you contrast that with a pure domestic business which we bought in Denmark in 2007 called Matas, which is the leading cosmetics and beauty retailer in that country. And obviously the investment thesis, the rigor with which we go through evaluating whether to make an investment is very, very similar in terms of wanting to understand the market, the competitive situation, the company's position, obviously the normal due diligence of understanding the quality of earnings, etc. in the business. And then at the end of the day, the valuation, both on inbound and expectations for outbound, together with the finances, get a stack up so that you, when you go into it, have a comfort that you can actually make a good return out of it. Now, the investment thesis between those two businesses, they are very different. One business is purely domestic in Denmark, where we acquired a set of independent businesses from the individual retailers. I think the team that I was part of their work on that probably would say it was the most complicated transaction they ever worked on. We had 158 SPA negotiations for a business that has revenues of a couple of 100 million euros. We were buying from individuals, and the investment thesis was to bring an independent wholesale organization into a capital chain of health and beauty stores in Denmark, take advantage of synergies in purchasing, a unified logistics, putting in merchandising systems, basically drive a business from a disparate group to a unified capital group. That was the investment thesis, and at the extension of that, potentially think of taking it to adjacent countries. 5 years later, that's what we've done. We have gone through the process of consolidating that. We have close to 300 outlets in Denmark. The business enjoys, depending on whose definition, in excess of 50% market share in this business. And the business is today making some 18-19% margins, up 5% from when we bought it.
And hopefully heading to the stock exchange.
And hopefully heading to the stock exchange if recent announcements materialize, which we genuinely hope, and we actually convinced they will, because that's where the company belongs.
Understand.
It's a household name in Denmark, and it's been a privilege to be associated with that. Ahlsell is a very different story. It is a pan-Nordic business already, the largest part being in Sweden, the second largest in Norway, third in Finland, and then some smaller businesses in the Baltic, and a niche leading position in Denmark. There, the investment thesis, among other things, of driving the performance, but if you look on the M&A side, Ahlsell has done about between 5 and 10 smaller add-on acquisitions every year. And there we're looking at expanding, other than doing the very, very accretive add-on acquisitions, where you effectively within a year reduce the acquisition multiple by half through tangible cost and purchasing synergies and logistics synergies. To also looking at some strategic acquisitions where we would strengthen our market position in certain products or in certain geographies across the Nordic region. And that is an integral part of the investment thesis there. If you go to the third portfolio company of ours, Cloetta, which is a public company now in Sweden, after the reverse merger of our leaf business into Cloetta, that business has a large presence in the Nordic region, in the Benelux and the UK, and in Italy. So there our geographical playing field is much, much broader.
Understood, yeah.
And you may have seen that the company, which is now public, announced a couple of weeks ago an acquisition in the UK actually of a very interesting candy manufacturer called, with a lovely name of Goody Good Stuff, that is adding to some of the product areas that Cloetta has, but also will enable us to play around product groups that even have a broader geographical scope than our current market presence. So, different logic for different businesses driven by pure business consideration. The fact that, there are growth markets in Asia and things like that, for some of our businesses, it is economically prohibitive to go there because we have no synergies, or we're coming in as a very small player into those markets. Whereas if you look from an Ahlsell perspective, coming back to that case, if we were to look at going into some markets where we don't have as strong a presence today, the synergies, we got to be convinced about the synergies, but we also got to be convinced that we very quickly can become a market leader, because otherwise the economics don't stand up, and therefore such an acquisition wouldn't get the support of the board. So long answer to a short question.
Understood.
But it really is driven by the realities of the business and the economics. And I think we're all aware of a number of the forays that company has done in the M&A field, but we've also seen over the last couple of years the enormous impairments that companies have gone through, be it in the paper and pulp sector, be it in the utility sector, up in this part of the world. And that is not part of the culture where we want to be. We want to have it driven by economics that we can be convinced of.
Thanks. A follow-up question, if I may, then maybe crystal ball glazing a little bit.
Ooh.
Opportunities are often found in places where there are certain changes taking place.
Sure.
On a global scale, European scale, but nevertheless also on a Nordic scale, there will be changes to banking financial services.
Yes.
And a wider array of service providers will be coming in, technology solutions and so on and so forth. What do you think, would that be an interesting sector to look at going forward as one where we might see also some inbound private equity activity?
I think that's a correct observation. We in the private equity world, we live in a very symbiotic relationship with the corporate world, and many people say that we are opposite sides. We're actually not. We are mutually dependent. We love to buy businesses from corporates, and we love to sell businesses to corporates, and I think that respect is mutual. We help them realize certain things, and that gives us opportunities to invest. And in sectors going through change, like the financial services sector now, with increased capital requirements, reserve requirements, etc., I think there is going to be a process that so many other industries have gone through of examining what is really our core business. And is our core business lending to corporates and to private equity, looking after corporate clients, or is it actually to be in the private wealth business, in the insurance business, and in the payments business, or whatever other business? And I think it is going to be and the Nordic banks, the large Nordic banks, all have a very strong track record of success. Their market capitalization and the returns are among the better ones across Europe. And I think they all want to maintain that. And therefore, I wouldn't be surprised to see that as we discussed earlier also, that at the board and at the top management levels, there are deliberations going on around, do we really want to have these and that activities? Or should we actually sell some of those? And take the funds to put into capital or to actually reinforce what we really genuinely truly believe are our core businesses. And I think that there are some signs that process has already started. Some of those are going to be reasonably delicate because they are probably, or part of those businesses are standalone, but others are probably reasonably integrated into the bank's or financial institutions' other activities. And therefore I can see that this will also lend itself to some type of partnership transactions where the financial institution will stay in for a period of time as part owner as one sort out some of those interrelationships and the business becomes a standalone entity, but also can participate in hopefully some of the upsides and the returns.
Correct me if I'm wrong, we might have even seen a couple of those over the past years, driven by maybe more a distressed situation. But let's remain observant and see what the future holds.
Yeah.